Stock investors continued to ignore unfavorable economic numbers today, June 4th, 2025. ADP reported that private employers added only 37,000 jobs last month, the lowest number in over 2 years. In another report, the ISM Services Purchasing Manager Index for May was reported at 49.9%, down from 51.6 in April. A number below 50 indicates a contraction in the services sector, which is far more important in the U.S. economy than the manufacturing sector. The new orders index plunged to 46.4 from 52.3 in April. That is a leading indicator. The price index surged to 68.7 from 65.1, indicating more inflation. All of those numbers are going in the wrong direction in the service sector. Both of those reports released today reflect how businesses are actually reacting to the Republican tariff taxes. Trump blamed Chairman Powell of the Federal Reserve, for those numbers rather than the tariff war that he started that is the actual cause. Lowering the federal funds rate by 25 or 50 basis points is not going to alleviate or cure the negative impacts from the Republican tariff taxes. There is also a cost associated with lower short-term rates that the Fed and politicians never mention or rarely do. Consumer disposable income available to spend, save, or reduce debt is lowered due to the Fed rate cuts as savings earn lower returns. Now, savers understand that has happened, and they certainly got whacked good during the Fed's jihad against the saving class when the zero interest range policy kept the federal funds rate at 0 to 0.25 for an extended period of time. That was far below the inflation rate. And the government's April personal income and outlays report, released earlier this week, I think, personal consumption expenditures increased only 0.2% month to month and 0.1% on a real basis. Consumer spending on goods declined by $8 billion, according to the government. The personal savings rate increased to 4.9% from 4.3% in March, which is consistent with a more cautious consumer. Also pointed out the government's last GDP report for the first quarter in my last blog that personal consumption expenditures declined significantly from the numbers reported, the actual final numbers reported in the third and fourth quarters of 2024. Trump increased the Republican tariff tax on all aluminum and steel imports to 50% from 25%, except for the UK that remains at 25% for a brief period. It may be raised later if they don't do what Trump tells them to do on trade. Those tariffs will have a negative impact on U.S. jobs, which is proven by all the studies of what actually happened in the past with steel and aluminum tariffs that were imposed by Bush in 2002 and by Trump in 2018 that were far lower than the current 50% number. There is a common sense reason for the negative economic net impact. Far more people are employed in industries that use steel and aluminum than in the steel manufacturing industry. Approximately 75 times more jobs are in the users of steel and aluminum. The Republican tariff taxes will also substantially increase U.S. consumer prices paid for products that are heavy users of those metals, leading to lower demand and job layoffs in those sectors, particularly in the automotive sector that are heavy users of aluminum and steel. This may not show up right away, but the cumulative effect of all of the tariffs on U.S. Automobile sales will start to negatively impact the automobile industry later this summer and into the fall. Earlier this week, the OECD reduced its estimate for U.S. GDP growth in 2025 to 1.6% from 2.2% forecast that it had made last March. Bond investors did not entirely ignore the economic reports released today. The 10-year Treasury yield declined by 9 basis points to close at 4.37%. I took that number from the Treasury Department's yield curve data, which you can find by Googling Treasury yield curve on Google. No one can predict the future. I certainly don't pretend that I can do it. Subsequent economic data can change my opinion and how I manage my portfolio. But when managing my stock and bond portfolio, I have to assess the economic data as it is now and will not assume that everything is going to work out just fine in the tariff war and other Trump policies that will likely create, in my opinion, major supply chain disruptions and increase prices, similar to what happened during and in the aftermath of the pandemic, a major cause of the problematic inflation in 2021 and 2022. In my next post, which will be published on Friday, I will summarize trades that reduced my stock allocation by over 5,000. I bought 20,000 in Treasury bills at auction this week so far, divided evenly between the 4-month auction today and the last month's 6 months auction. Last Monday's 6-month auction, excuse me. The investment rate for the 4-month Treasury bill was at 4.323%, which is near the midpoint of the current federal funds range of 4.25 to 4.5%, and is consequently inconsistent with a rate cut on or prior to the September meeting. The stock jocks may be reacting positively to an anticipation that the Fed will cut sooner, and that may explain what they're doing. But if the Fed does cut sooner, it will be what I would call a negative reason for the rate cut, meaning a concern about a recession developing. Also bought 13,000 in principal amount of investment grade corporate bonds that I will discuss in my next post. I've been going out further in maturities with these purchases. I can take on more interest rate risk since I am extremely heavily weighted in short maturities, so I can take on a little bit more interest rate risk that is inherent in going out to 2030, 2035 maturities. Most of my purchases in that time range have been first mortgage bonds issued by operating electric utility companies.